All right, guys. So I just kind of want to go over briefly all the different types of spreads. All right. I'm not going to go into a ton of detail on each one, but I at least want you to know what they are, how to structure them, and when to use them. All right. So a lot of you might know, if you're bullish and you think the stock's going to go up, you buy calls, right? If you're bearish and you think the stock's going to go down, you buy puts, right? And, the problem with that is, sometimes if the stock doesn't move in your favor right away, you end up losing money. You might be right about the direction that it goes, but you might be wrong about the time, right? That's why weeklies are a little bit more risky. Like you have to be right like that, okay? Where opposed to like leaps where they're like a year out, you have a lot of time for it to work in your favor, but you're still highly delta exposed, meaning if you go long calls that are a year out and the stock starts dropping and it drops quite a bit, you're still going to lose quite a bit of money, right? So, I think it's useful to know the different types of option spreads. So, the first one I want to talk about is the call debit spread, okay? So, hopefully you guys can read this. Call debit spread, okay? I don't think you guys can read that. Anyway, call debit spread, right? So what you're doing is, and for all of these, so here we have 80, 85, 90, 95, 100, 105, 110, 115, 120. And right here is where the stock is. We're just talking about stock XYZ trading at 90 right now, okay? So let's say, you would do a call debit spread if you think the stock is going to go up, but not that much, right? So you're bullish, but you don't think it's going to go to the moon, right? So like for stock XYZ, I might say, okay, I think with the stock trading at 90 in the next few weeks, I think it's going to go up to 100 or 105 or maybe a little bit higher, but not much higher, okay? So what you would do is you would buy the 100 strike call, and then you would sell the 105 strike call, okay? And what you end up getting is so this would be, I'm going to show you what the risk profile would look like. So it will kind of look like that, okay? So I wonder if I move this a little bit closer, if you guys could see better. There you go. Okay. So you end up looking with something like this, okay? So your max profit is right about that 105 or above, okay? And then let's say you pay $100 for this 5-wide debit spread, okay? Basically, your max upside potential is $400 with only $100 of downside risk, okay? So that would put your break even here at about 101, okay? And then anything below that is where you start to lose money, okay? Below 100, you're basically at max loss, okay? So, as long as you think the stock is going to go up, let's say this has 3 to 4 weeks to expiration, as long as the stock ends up in this 105 or above area, you make all $400, okay? The stock could go to 150, right? And you would still only make $400, okay? But what's the benefit of that as opposed to just buying straight calls, right? So if you buy calls 4 weeks out and the stock just kind of moseys along in this 100 area, that call that you had that's 4 weeks out, you're losing premium on it because it's not moving in your favor in the right amount of time, okay? So even if the stock ends up at, let's say you have like a 105 strike call, okay, that you paid, let's say $300 for, okay? Even if the stock ended up at 105, you lose all of your premium, right? So the stock has to get to, if you paid $300 for it, you have to get it to 108 or higher just to break even on the position, okay? So that's why doing a call debit spread might be more beneficial in situations like that. So I'm gonna break these up into different videos.